The only thing that happened since the Fed cut rates is that the banks are making more money. That's the bottom line. Again, it's cutting rates here is stupid. All that's going to do is create higher inflation.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for August 18th through August 25th, 2025, while supplies last. First this week, the 1-ounce gold Australian kangaroo or gold nugget coin are just $60 over spot per ounce. Next, pre-33 US gold $10 Liberty coins are $50 over melt for AU grade and $70 over melt for BU grade. Gold 20 franc coins are just $30 over melt per coin. Next, silver Australian kangaroos are only $2.79 over spot per ounce, and with a 250-ounce monster box, they're the lowest price monster box available. Finally, silver 10-ounce Nordic mint bars are just $1.89 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Todd Horwitz, also known as Bubba from Bubba Trading. Todd, thank you so much for joining us today.
Elijah, always great to be with you. Lots to talk about.
Definitely a lot to talk about today. We're seeing gold and silver spike, and also the stock market spike today after Powell's comments at the Jackson Hole meeting, really kind of opening the door to rate cuts soon. Your perspective on his comments there?
Well, I mean, listen, Powell's going to, they believe they may need to cut rates. Jobs have been pretty bad. But, whatever he has to remember is, the markets are very exuberant right now. But just because the Fed is going to cut the Fed funds rate does not mean that you, the consumer, is going to get a benefit from that rate cut. That is a cut to the banks for their lending rate, and that doesn't necessarily get passed on to the consumer. So I don't know why we're so excited here, but of course, this could be also a combination of a short squeeze because the markets have been under pretty heavy pressure all week.
No, with respect to the short squeeze, I mean, what are you seeing? You're trading day in and day out. So what kind of action have we seen this week that leads you to this conclusion?
Well, I mean, the markets have been extremely slow. I mean, we're in the slowest 2 weeks of the year, other than the weeks between, the December expiration and New Year. But again, you had some pretty good selling this week. You've seen a lot of push down on thin volume. So now all of a sudden you get news that's being interpreted as good news. All the guys that were getting short, all the traders that were shorting this market are now forced to cover, and you get these exorbitant moves now to the upside. I mean, the Dow's up 900, the Nasdaq's up 400. At the end of the day, we'll see how it settles out before it's all over, but this is a very common action for a short squeeze. Typically, an up market will not run quite as fast and as far as it's running right now. So to me, it indicates more a lot of shorts are covering versus new money coming in to be a buyer.
Now, last time we had you on, we were talking about your concerns regarding the stock market, and we've really been tracking this with you. You remain, bullish to the upside short term, but long term, you're really looking for a significant correction. You talked about last time how some of the concerns come from the tariffs, right? And we did see extensions this last month, just the beginning of August, on a lot of these deadlines. Do you think that is impacting anything with respect to the stock market at the moment?
Well, I mean, it's not really having obviously much effect now. We're either at or near all-time highs. But I think you have to look back and look at the jobs. Look at how bad the jobs are. I mean, now you've got 5 million people whose unemployment benefits are going to expire. They're not going to have anything. You've got inflation still soaring. And if they cut rates, inflation is going to go up even faster. So that doesn't bode well for the market. There are a lot of warning signs out there that suggest the market should sell off. But again, you have to decide if you're a trader or you're an investor. If you're an investor, you should just ignore it and let the markets go because they're going to go up, they're going to go down. At the end of the day, they're going to be up 8.5% year over year. If you're a trader, then you would probably be looking for a spot to sell in here at some point because, again, there's going to be a correction. There are always corrections, okay? In history, we always see market meltdowns. They come back. But again, you now have layoffs, job problems, economy problems, high interest rates, housing problems. So there's a lot of warning signs out there that we're just ignoring. And of course, that does also bode into the the lack of participation in markets right now. That goes into the low volume. That goes into what's the lack of what's happening. When we get back to work after Labor Day and through September, October, we'll get a better, clearer picture if we're really this bullish or we're just moving around in a very thin market.
A lot of people have mentioned that this run-up in the stock market that we've seen has been largely driven by tech companies and AI. We did see some concerning reports from some tech companies showing that they had good growth, but they're projecting kind of slower growth going forward. What is your perspective on that? And is that also a concern for you?
Well, I think that's another concern. I mean, again, remember, everybody forgets, but if you go back into the 90s and the original internet bubble, I mean, you got stocks that are jumping up, 2, 3, 4, 5% a day like it was nothing, like they were giving them away for free. At some point, that's got to end. At some point, they have to make enough money to justify the stock price. And this always happens, and this goes back to, again, we get a little bit too much overbought in here, and we were historically overbought coming into this week, and we did see a little bit of a sell-off, relieving some of that overbought condition. But we'll see. But again, these, Palantir went from $10 to $190. I mean, again, those are ridiculous numbers and ridiculous moves, and they cannot last. Now they can last longer than we think, but anytime a market goes in a parabolic fashion, it is 99 out of 100 times going to correct and come back, and I think that's what you're going to see.
Now, you recently on one of your video blogs you were talking about the RSI for, I believe, some of these major indexes here. It's showing really concerning developments. We're seeing a lot of, I guess, can you explain that for our viewers? What is the RSI and what?
There's an indicator called the relative strength index. Okay, but when the markets are making new highs, the relative strength index, or the RSI, was going lower, which is not the correct. That's a divergence, which would mean that the markets figured this out. Now, they did sell off after I made that video, and they sold off pretty significantly until today. So we'll see, but that is still going in the inverse direction, which at some point will help these markets come down a little bit. And of course, the VIX index is getting awfully low as well now too, which also indicates that we're getting a little bit too complacent in these markets. And it is very typical when markets are making a top. And again, I'm not saying the top is in, but when they're making a top, it takes time. You see these divergences start to show up. You have these other warning signs that are along with it. And one day you walk in and the markets start to go down, and they don't retrace and make another new high. They just make lower highs, and you get into a downtrend, and then you get the panic sell-off.
We've been tracking with you gold and silver, and obviously today we're seeing quite a bit of a pop. We've largely gone sideways over the last couple months, though, at least for gold. Did you want to give us an update on your view on gold and silver at the moment?
Well, I still think gold is going to sell off a little bit. Again, now listen, I think gold's going up overall. I think gold's going dramatically higher. Okay, I don't think it's going to higher this week. I think this move is purely, again, they're still sideways. Gold is still stuck between 3,300 and 3,500. Silver is still stuck between the 36 and 40. I would expect silver to outperform gold over the next few months. I would expect to see silver get over 40, maybe even as high as 45 before we go. But again, you have to look at the market. You have to look at the tape and the action. So yes, the gold is having a big move today, but it's had some big moves down. And if you look at it, it's really just stuck going sideways. And that hasn't changed even when we were up $40. We're up 32 now, but when it was up $40 this morning, it's still sideways. Nothing has changed. Investors and traders alike have a tendency to get too excited over a short-term blip in the market. And I think you have to look at the overall performance. And until gold breaks above 3,500 or breaks below 3,300, I think it's going to continue sideways. My opinion is it'll break to the downside first, and we could see 3,200, even 3,100. But overall, I'm very bullish gold in the long run.
Also platinum, we've tracked with you. It had a huge run beginning the year, just until about a couple months ago when we almost hit 1,500 there. But now we've sold off a bit. It's popping again today, but mainly sideways. And some of the people that I talk to are kind of concerned about the price action we've been seeing over the last couple months. What is your take?
No, I think that the platinum is doing exactly what you'd expect it to do. You had a parabolic move up. It went up about 65%. So again, you have to the market has to relieve that overbought condition, and it's doing it by going sideways. Is it more bullish? More often than not, oversold or overbought markets will make a V formation and go either straight up or straight down. Platinum did not go straight down. It came down to a level it found some new support, and now it's just adjusting. When you look at markets and they start to consolidate, that means another move is coming, another trend. Now, whether it's going to be a trend up or a trend down, I think it'll be up, but it can be either way. It can break into either direction from here. But the original 65% move was a little bit too fast and too furious for the market. There's not enough capital in the world that continue those types of rallies.
I did want to shift our focus now to the economy in general and how this is going to be impacting the middle class. You talked about at the beginning how what the Fed is doing right now, it doesn't seem like it's actually going to be fixing anything, even if they bring rates lower. So did you want to give your broad overview on kind of where we are at the moment, and especially with respect to what the Fed is doing?
Well, I mean, the Fed is ridiculous. I mean, let's face it, the Fed has no clue, and they're well outside their mandate. They have two jobs. One is price stability and one is jobs. They're not supposed to be playing with the interest rate market, and they're not supposed to be listening to the president who wants lower rates. And of course, Jerome Powell has stood strong. And again, I'm no fan of Jerome Powell, but lowering rates is going to create massive inflation. Okay, we've been through this before. We've seen it before. And again, I remind you that just because the Fed funds goes down does not mean that the banks are going to lower the rate to the consumer. There is a demand for money out there. People, the middle class doesn't have any money. They're borrowing, they're leveraged out on their credit cards, they're trying to borrow, and they're not paying, 6% or 7%, they're paying higher. So the markets can certainly tolerate higher interest rates. And if you go back a year, which is the last time we had cuts, the Fed funds rate is down 100 basis points. The lending rate, the borrowing rate is up 100 basis points on standard, which tells you that the only thing that happened since the Fed cut rates is that the banks are making more money. That's the bottom line. Again, it's cutting rates here is stupid. You want to cut down our debt? Quit spending so much government money. Okay, quit pissing the money in the garbage can and become fiscally responsible. This is the problem with government in general. And even the big, beautiful bill. You can like it or not like it, but why should we be spending more money when we need to cut back on our spending? I mean, you want to spend for defense, great. But you want to spend on all these other programs, it doesn't make sense.
Focusing again on inflation, then going forward, the Fed continues to be concerned about inflation with respect to tariffs and all of that. So what is your view of inflation at the moment, especially in light of the recent Fed comments?
Well, first of all, the CPI number that's come out has been ridiculous because there's no way that we're slowing on our inflation. Inflation is, we are still paying more for groceries. We're still paying for it. The only thing we're not paying more for right now is I think eggs have come down a little bit and gasoline has come down a little bit. But overall, we're still paying, and they cut rates. That'll spike the price of inflation once again. This is again something that you don't understand, but it really all relates back to spending. Okay. And you have to, if you're an individual, you have to have a budget. You have to not overspend. You have to make sure that you can buy groceries. And it goes to the government level where they just, again, they've got too many special interests that they're spending money on when you want to reduce the debt, not increase the debt. And of course, we continue to increase our debt, and, they're borrowing so much money that the cut, they want the cut to save on the debt service, but the debt service we should be cutting the spending and cutting debt service that way, not by trying to manipulate or change the interest rate market, because all that's going to do is create higher inflation. The banks are going to make more money. And again, I'll say it again, that doesn't mean that it's going to help the little guy, okay, the middle class. I have no problem helping the rich. I mean, the rich are what pay the jobs. They're the ones who own the companies, they pay, and there's nothing resistant. That's what capitalism is about. If you're good at it and you can make a lot of money, I'm all for it. Okay. So again, but at the end of the day, an interest rate cut is not going to help the middle class guy making $75,000 or $100,000 a year. Okay. It's not going to help them. And that's the problem with the whole thesis behind what the Fed is trying to do and what the Fed is talking about.
And you mentioned the banking system, that this is going to be helping the banks. What is your current view of that? Because it seems like we have seen concerning developments over the last couple of years with respect to interest rates being high. And if you mark to market a lot of banks' assets at U.S. bonds, then they're underwater. And now we're seeing other issues with respect to kind of parallel issues with respect to commercial real estate loans. So that echoes what we saw in 2023 with respect to U.S. debt holdings by banks. So what is your current view of the banking system? Do you think we're out of the woods at the moment, given that these new policies are going to be helping banks, or are there still concerning developments ahead?
No, I think the banks are in serious trouble. I mean, again, they won't admit to it. The stress tests keep coming back glowingly, but I think the banks are over leveraged. I think they have a lot of bad paper on their books. But at the end of the day, this is the problem with the accounting that they're allowed to do. You know, the banks, fractional banking, they can lend out 10 times what they're holding, supposedly. Now, we know they all do more, but let's just say, go with the formula. But the real problem here is that the banks can borrow $1 million from the Fed, for example, from the Fed funds rate. They can take that liability, turn it into an asset, and then lend out $10 million. Again, they're dramatically over leveraged once again. And listen, it may not happen today, it may not happen tomorrow, but at some point, we're gonna have to pay that bill again. And unfortunately, under the current set, the taxpayer is the one who has to bail out the banks once again. And who gets hurt the most on the taxes is the little guys get hurt the most, because it's if you're making a lot of money, a little bit more taxes isn't going to make a difference. But if you only make, again, we'll go back to 75,000. If you're making 75,000, a little bit more taxes is a big percentage of your income. This is what people don't seem to understand. Okay, that again, there's nothing wrong with the rich in getting away and getting tax breaks, because they pay the most amount of taxes. They're the number one funder of the Treasury. But when you bring in these rates and you bring in these problems, and then again, if we have to bail out the banks again and the American taxpayer has to pay for it, that's a problem, because for the majority, they can't afford to pay those taxes.
And it's not just bailouts that are a possibility. A lot of people have talked about bail-ins, or, there was that concern in 2023 of, is my money safe in the bank? Because you saw Silicon Valley Bank and First Republic Bank and these other banks go under, and that was the big concern back then as well. Is the government going to be just, guaranteeing all of the assets that people have in the bank, or is it going to be kind of just you only have 250,000 or so in for FDIC insurance? So your perspective on that, could that be a way that the government bailouts is just not protecting these banks, or how?
Well, I mean, first of all, you could be very cognizant yourself. If you've got a big account, you should separate that out so that you do have the coverage of insurance. But again, I go back to 2008 when they bailed out the banks. I just said, don't bail out the banks, bail out the depositors, and screw the banks. Okay, the banks are running a business. Wouldn't you like to run a business where you have no risk and you can make a fortune? And if things go bad, you get the taxpayer to bail you out? That's not a very good situation that I look at. And again, they have to, to take care of the consumer. Okay, they don't have to take care of the banks, the business. They have to take care of the consumer, which, again, you go into these insurance policies that they have, but of course that's on the consumer to make sure that they don't have X amount of dollars in any one account. And you can open as many bank accounts you want at different banks, okay, to separate those funds out. If you're worried about that scenario. Now, I don't think the banking system will ever fail. I think that we're well past that. We've already seen the Federal Reserve and the government bail out the banks. So, but again, could there be issues? Could there be a run on the banks? Of course there could. I mean, there's always the possibility that something go wrong. But I think if the government lets the banks fail, which again, I don't like the banking laws as they are. I think they need to be changed. But let's just assume we have it as we have today. If they let the banks fail, you got a lot bigger problems than the amount of money you're going to lose in the bank, because that means the country's going to fail. So there's a lot to be said about that. If America fails, there's a lot more problems than just what you have invested.
Right. And you're also going to probably see a confiscation of your assets through inflation if it's not just outright confiscation as well.
Well, listen, we've seen that forever, right? If you go back to, I'll give you one stat. You go back to 1985, the average income was $25,000. The average house was $75,000. Okay. Today, the average income is $75,000. The average house is $500. You do the math. Okay, 3 times versus 7 times. That's how much money the government has fleeced the American people out of with their inflation.
Definitely. And I guess the broad overview, as we kind of circling back here to the Jackson Hole meeting, we're seeing, big moves in the markets today. Do you kind of suggest caution for our viewers who might be trading the markets or investing in the market right now?
I wouldn't be buying here. I'm selling my, listen, let's be clear. My investment portfolio, I'm not doing anything with. My trading stuff, I'm selling into this rally, okay, myself. Doesn't mean I'm right, but again, this to me is false. It's more of a reaction to what's going on. We'll see how it plays out over time. But again, I think that there's a lot more problems than we're not cognizant to right now. I think there's a lot more things going on that are not good for the average American. And you have to recognize what it is and what's going on. But the biggest problem for any trader right now is the lack of liquidity, the lack of volume right now, and the lack of market participation. So it makes it much bigger, more of a challenge, because markets can move a lot faster in either direction because there's nobody in the way on either side.
All right. Well, Todd, Bubba Horwitz, we really appreciate your time today. As always, people can go to bubbatrading.com if they're interested in learning more. Share with us a bit what they'll find on Bubba Trading.
Well, you'll find our education programs, our hedging program. We can hedge your portfolio to a mathematical certainty, which is what I do for myself. But we're really big on education and helping people learn to understand the investing world and what it takes, and knowing that, you don't have to panic. You have to learn to be more patient and quit chasing around the hot stocks and things like that. I mean, we're really big into educating because, again, the financial literacy in this country is abominable.
All right. Well, Todd, we really appreciate your time today. As always, thank you so much, and God bless.
Thanks, Elijah. Appreciate it.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for August 18th through August 25th, 2025, while supplies last. First this week, the 1-ounce gold Australian kangaroo or gold nugget coin are just $60 over spot per ounce. Next, pre-33 US gold $10 Liberty coins are $50 over melt for AU grade and $70 over melt for BU grade. Gold 20 franc coins are just $30 over melt per coin. Next, silver Australian kangaroos are only $2.79 over spot per ounce, and with a 250-ounce monster box, they're the lowest priced monster box available. Finally, silver 10-ounce Nordic mint bars are just $1.89 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.